Welcome. Have you ever wondered how these huge, multi-million-dollar financial deals get done without using a public stock exchange? Well, today we're going to break down the entire life cycle of what's called an over-the-counter or OTC trade, step by fascinating step. So, yeah, how do these things actually work? We're talking about this massive private market that operates directly between two parties, completely off the grid and away from the spotlight of, say, the New York Stock Exchange. And here's the key difference, right? When you buy a stock on a public exchange, it's all standardized, it's anonymous, you don't know who you're buying from. In the OTC world, it's the complete opposite. It's a direct, private negotiation where every single detail of the deal is customized between the two parties. Okay, so part one, laying the groundwork. How does a deal like this even get started? Well, just like building a house, you have to get the foundation absolutely perfect. This first phase is really a two-step dance. First, you have the trade initiation, which is kind of like the initial handshake, where both sides agree that a deal is possible. Then you have the trade execution, where they make that agreement official and legally binding. So trade initiation is that high-level discussion. It's like agreeing on the price of a house in principle. The traders get all the important people to the table to hash out what the deal could even look like, tailoring it to exactly what they need. And listen, it is not just two traders on the phone. It takes a whole village of experts. You've got teams from legal, risk, and operations. Even the IT team and the Know Your Customer, or KYC team, they all have to sign off to make sure the deal is even possible, let alone compliant and safe. So once all those teams give the thumbs up, the deal is formally executed. And this moment is so important, it gets its own special name, the trade date. From this point on, there is absolutely no turning back. Now, to make the deal official, a ton of paperwork gets exchanged. To make this whole process smoother, parties will often use standardized legal frameworks, like an ISDA agreement. You can think of it like a master checklist to make sure not a single detail gets missed. All right, part two, capturing the details. So the deal is signed. The next phase is all about pure precision, logging every single detail of that agreement perfectly into each party's internal systems. And this really boils down to two key actions. First, you have to capture the raw details of the trade itself. And then second, you enrich that data with all the other essential information to create the full picture. Now, this is a huge moment because it's the very first time the trade officially exists as a digital record. Every single key detail, what was traded, how much of it, the price, and who you traded with, it's all finally logged in the system. But here's the thing, that raw trade data alone isn't enough. The system then automatically enriches this record. It pulls in what's called static data, basically all the background information about the client that doesn't change from deal to deal. And you can see the difference pretty clearly here, right? Trade data is what's unique to this specific deal, like the price and the quantity. But static data is the client's permanent info, their name, their contact details, their payment instructions. You need both to have a complete record. Okay, moving on to part three, the crucial double check. So both sides have the deal recorded in their systems. Now comes what is honestly maybe the most critical part of this entire process, making absolutely sure the records are a perfect match. So think of this phase as a three-step checking process. First, you verify the trade internally to make sure you didn't make any typos. Then you send your version out for confirmation. And finally, you receive their version back for affirmation. It's a really simple but vital two-way check. Confirmation is you sending your details out and saying, hey, this is what I've got. Affirmation is receiving their details back so you can check them on your end. Both sides have to agree they're looking at the exact same deal before anything else can happen. And this back and forth, it happens over secure financial networks like SWIFT, or sometimes even just email, and it goes on until every single detail is a perfect match. The goal here is to create a perfect mirror image of the trade on both sides before any money or assets actually move. All right, part four, the final exchange. So the deal is logged, it's enriched, it's been double-checked from every angle. We have now reached the climax of this entire journey, the actual exchange. This is the moment everyone's been waiting for. Exactly. After all that digital back and forth, when does the real stuff, the money and the assets, actually move? Well, that happens in the final, irreversible step, settlement. This is when the deal goes from being a contract to being a reality. And you better believe there's a deadline for this. Ideally, the whole process, from the initial trade date to this final exchange, has to happen within 7 business days. So yeah, the clock is absolutely ticking. So that clock starts ticking on day T, the trade date. The next 6 days, T+1 through T+6, are for all that intense verification and checking we just talked about. And the finish line, the grand finale, is on T+7, the settlement date. And this is it. This is the tangible result. It's like finally getting the keys to your new house. The buyer's account gets credited with the asset, the seller's account gets the cash, ownership has officially changed hands. The deal is done. So, after going through all of that, let's just step back and look at the big picture. Why does this whole process matter? Why is it so rigorous and, let's be honest, sometimes a little tedious? And the answer is, this isn't just bureaucracy for the sake of it. This entire intricate life cycle, well, it's the fundamental financial plumbing for a multi-trillion-dollar market. It's what prevents simple mistakes from turning into absolutely catastrophic failures. It's this incredibly complex dance built on pure precision, all designed to be flawless, which, it leaves us with one heck of a final thought to chew on. In a system that's this interconnected, what are the real-world consequences when just one of these steps goes wrong?